Hi, this is Randy Finney with Right Side of the Chart, and today is Wednesday, April 5th, 2017. I wanted to do a video. I'll start out with a quick overview of the broad markets on the short-term time frame. That can get tricky to call, but I still maintain that this bounce may have run its course. And the common theme to this video will be the disparity between just a handful of large cap stocks that have continued to lift this market, not just over the last year or so or the last 6 months, but more importantly on this recent rally up. I'm going to show you, give you some evidence of that. And well, we'll start out. We're looking at the Qs, and that's been the leading index. And as I said, that's also, of all the major indices that are actively traded, you have the NQE minis, the QQQ, one of the most popular ETFs. It is by far the least diversified index, only 100 companies, 107 to be exact. And of those, almost, very high tech weighting with a little kicker, consumer discretionary, with, of course, the king of all consumer discretionary companies, Amazon's in there, and Amazon's been lifting. So this is what we're looking at. We're looking at the Qs and a 30-minute chart. If I don't make mention, it's right up here, the time frames. And it's simply been this. It's been a series of divergent highs recently. You had to see the negative divergence. You had negative divergence at that high. We went on to double top that high, had one more equal high there. That put in even steeper divergence, and then boom, correction. At that point, we had a divergent low, and we rallied. Rally went a little farther than I thought it would. I'll certainly say that. But again, it's only been 3% off the lows, and again, by far, this was the strongest index. So you had, after a divergent low, a rally. Right now we've come full circle. If we turn down here, I can start to see the MACD curling over. It hasn't yet crossed over. We need to see a crossover at or below this previous high to confirm that divergence. And if so, we'll have another divergent high. I could probably draw a trend line there for you. Most certainly could. Let's look. So here we have a bearish rising wedge pattern. It's pretty clean. And this is what I'm on the lookout for. I'm sort of in a holding pattern. I made mention in the trading room today, which I'll get to in a second, that I don't care what the Qs do. I don't even care if the broad market's going to make a slightly marginal new high. The Qs are the only one that has done that yet. So this is what I'm looking at. I'm expecting a reversal. And I just want to make clear that, and I made it clear in the trading room, I haven't at this point, not even remotely, abandon my views that we're still looking at a significant correction coming up here soon. And these are the, some key support levels on the Qs I'm watching. I called this one, I posted it on the site the other day, should do the trick support, meaning even though that low needs to be taken out. That's the nail in the coffin. Critical C is support. When we take out, those are the lows from last Monday, previous Monday, I believe was March 27th. It's also horizontal support. There's some reactions there. And if and when that goes as I expect it will, particularly or especially if the lows go on the major indices, which I don't see why they wouldn't, because the Qs are way above those, the SPY, mid caps, the Dow, small caps. So that's what I'm looking at, guys. Here's your first sell signal would be a break of this bearish rising wedge, and your next sell signals would be the break of either of these two support levels, and then this is probably an all-in short. If we get down here, see what I think will happen. If they start to fade this rally, sooner or later we're going to have that momentum build up to the downside and see that quick selling. But either way, the technicals are what they are, and this is what I see right now. Now, these divergences have the chance to be negated, or that means taken out. If we take out these previous reaction highs, then we no longer have negative divergence. That doesn't mean that the entire bearish case is thrown out, because what we're going to get to here in a minute are the longer term charts. But this is what I see on the Qs, and that's what I'm watching. All right, let's look at a couple other indices here. Now, this is what I mentioned in the trading room today. A couple things. The QQQ, as I said, is one of the, although it's one of the most popularly traded indices, it is by far the least diversified. It's very, very, very tech heavy, with a big consumer discretionary kicker. Most of that, the performance in the consumer discretionary aspect of it is related solely to one company, and that's Amazon. So the Qs, not only is it top heavy, the top 10 components account for over 50%, over 51 actually, percent of the returns of that index. Right now, as of today, with the Qs making new highs, we have only 4 of the top 10 companies, top 10 holdings in the Qs making new highs. That's Apple, Microsoft, Facebook, and Amazon. The remaining 6 in that top 10 are well off their highs, not even close to making new highs. So that's point number one. That speaks to a continued deterioration in market internals, showing you fewer and fewer stocks are doing the heavy lifting. Don't believe me? Let's take a look at the Nasdaq Composite. Remember, the QQQ is just the largest 100 or so. It's actually 107, but roughly the largest 100 stocks within the Nasdaq Composite. Well, here's the Nasdaq Composite. Let's look at it on this screen. Here's the previous highs on Nasdaq. We've had 3 failed attempts. We tested the highs recently the other day. When was that? Friday. And again on Monday morning, failed. And we tried to take it out today. We punched through it intraday, but so far fallen back. So the Nasdaq Composite, unlike the QQQ, is not trading at new highs, nor is the Nasdaq equal weighted index. This is NDXE, Nasdaq 100 equal weight, where they don't give that top heavy weighting to Apple and Amazon and those handful of leaders I just talked about. So look, it's close. If it pops up to new highs, does that mean, oh goodness, that we no longer have divergence? Not the case. You still have the composite, the equal weighted Nasdaq 100, and much more importantly, guys, is all the other major indices. Let's try to find a clean board for you here. Here's the SPY S&P 500. Let's go to a 60-minute chart. We can go back to the 30-minute chart that shows the highs. There's a high on March 1st. We're still making, as I pointed out, and it's not even close to being in jeopardy, a series of lower lows and lower highs. There's your lower highs. Here's your lower lows. That is plain and simply the definition of a downtrend. So the near-term trend is bearish and not even close to being bullish until and unless this reaction high here is taken out. So we're not even close there. So let's get that established. Now, this is a much more representative, an index much more representative of the U.S. economy because it has a lot of sectors within it instead of just a handful. And it's much more diversified. I pointed out these levels recently. I had the 61.8 fib, the 50% fib, and I'm talking about the move off the March 1st highs, that downtrend into the lows. So far, we failed. We attempted to take out that 61.8 fib. Just the other day, I pointed out that there were some pretty key resistance levels, horizontal price resistance that lined up. This one was just above the 50% fib. We challenged it for a while and did turn back down. We went on to take it out. I'll give it, they won that battle. A war is just a culmination of the battles. If you win enough battles, you've won the war. There's a lot more battles to be fought on SPY. Next one being that previous reaction high and then the all-time highs. As of now, so far we're failing here. We've turned down. If we fail to surmount this on a closing basis, that 61.8 fib retracement level and this horizontal price resistance around 237.10, and we turn back down, that's bearish. I gave you a bearish rising wedge on QQQ. We can certainly draw an uptrend line here, and you can see a bearish rising wedge confirmed with negative divergence on the SPY. So your next sell signal on the SPY, and it may want to work its way up just looking at this wedge, how far away the apex is. Maybe we work our way up a little bit, but this would be your next sell signal, break of this bearish rising wedge or this uptrend line here on the 30-minute chart. All right, let's just look at a few more. MDY, mid caps, you can see they're struggling with the 50. They're still below the 50% retracement from the move down off their highs. Very much entrenched in a near-term downtrend, as you can see here. Not much more to say about that. Small caps as well off their highs. As you can see, still well in a downtrend. Series of lower highs and lower lows. Yet to even, we popped above the 61.8 fib retracement right after on that recent rally, but failed with some impulsive selling so far. Also note how they faded. There was a pretty nice pop this morning, and that was faded all the way down, I believe, back to, they did. They backfilled that gap and then some today so far. So looks like the rallies are getting sold into on IWM, but it's anybody's game. I pointed out in the trading room to somebody that inquired about IWM short. At this point, I'm chock full. I have enough short exposure that I want to have right now. I certainly have room to add, but what I'm waiting for is a definitive break from this range. I've talked about this sideways trading range goes back to early December, and we're right in the middle of it now. So what we really need to see, just like with all the other indices, is just a break of the lows from the previous Monday before last. That was March 27th again, I believe, right here. And when we do, that will likely could lead to a very powerful sell-off, because this is a multi-month trading range, and from such tight sideways trading ranges usually come big moves. Maybe it comes to the upside. I don't see it now. I'm going to make that case here in a second. Again, this is stuff I've all gone over before. Looking closer, I mentioned there's it's in the trading room. I mentioned an objective level to add on some short exposure if we get back up there. But I'm holding off right now and waiting to see if first we break those bearish rising wedges, and of course, most importantly, can we take out the lows from March 27th. All right. At this point, let's go ahead and segue into some of the longer term stuff. I talked about how market breadth is we've seen a tick up. A friend of mine sent me an article. I'm a stock chart subscriber, so was he, and he sent something from, who was it, John Murphy, one of those guys. I'll be honest, I don't find his commentary very useful. I find it very hindsight. He's usually, telling you what happened today, and he'll make a forecast of what might happen, but I shouldn't knock. I just don't read it much. But one thing he was saying that I had to disagree with is he was pointing out how the percent of stocks above their 50 or 200-day moving average were increasing recently. Well, of course they were in the last week or so, because the market was going up. The thing is, they're increasing less than the overall market. I'm going to get to that in a second. Before I do, I want to make mention of one thing. I know that the fundamentals lately, the economic data, has been coming in very positive. I mean, we had a blowout number today on non-farm payrolls. So that's the employment numbers were up. There's a big increase in employment. New jobs added, more than expected. And that's been the trend lately. Now, what's going on is, a lot of people are saying, wow, this economy is red hot. Well, if that's the case, how come the market topped on March 1st? Again, every single index except the Nasdaq 100 has peaked on March 1st, or the Nasdaq Composite, I should say. The tech-heavy Nasdaq. It's one and the same, really, in my opinion. So this is telling a different story, and I like to say this. There's an old saying in investing and trading that it's always darkest before the dawn. If you guys think back to the sell-off leading into the March lows in 2009, just about everybody thought the world was coming to an end. They thought the banks were going to shut their doors, and because of that, they thought the banks were going down, and there was all this talk that all the businesses were going to have to shut down around the country because they couldn't make payroll, and the Dow was going to 200 and blah, blah, blah. Well, that was right when you had the best buying opportunity of certainly of a lifetime, maybe for the last century or more, led by one of the most powerful bull markets. So keep that in mind. Now, there's a corollary to that. At least this is my corollary to it. Just as it's always darkest before dawn, it's always brightest before dusk. And that's the thing with the markets. You're always going to see near the top, blowout numbers, great earnings, great economic data, and that's indicative of market top. The thing about the stock market is it looks out 6 to 9 months ahead. Why is that? Well, number one, you have insiders right now knowing what's going on with a company that you and I won't know about for 3-6 months or more easily. Think about it. Companies report earnings every quarter. There's a 1 month lag before they do the reporting from when the quarter closes. So that data is up to 4 months old in some cases. Even then, there's a lot of manipulation on the books, moving things here and there. Economic data is just as lagged. You have GDP reported quarterly. GDP is almost always subject to hindsight revisions. So by the time GDP is reported, it's already lagged. Then you get these after-the-fact revisions. Never in history has a recession been identified until well after the economy was fully entrenched in a recession. Has the government come out and actually declared a recession? That's a function of them waiting to see the two consecutive declining quarters, two 2 consecutive declining quarters of GDP. And then, like I said, it's often subject to revision. So then they look back and they say, oh, well, the recession started 9 months ago or whatever. Yeah, thank you for that. Anywho, I'm just trying to make the point that don't be confused with rosy economic data, rosy, quarterly earnings. Don't get that confused with the outlook for the next 6 to 12 months in the stock market, or even the next 3 to 6 months. Just keep in mind that a lot of that, possibly all of that, has been priced in. Okay, so now we'll move on, and I'll get into some breadth indicators. And let's see here. Okay, what I'm going to go over now are some charts. A few of these I did cover the other day. I think these are very important and, in my opinion, very telling. Now, I'm going to say what I said in the trading room, that I've been wrong before. I'll be wrong again. So do your own due diligence. Trade according to what you think. But I'm of the opinion that the damage has already been done. We're looking, and I'm referring to the deterioration of market breadth. And I made mention about how it was someone from Stock Charts, maybe Murphy, one of those guys, mentioning how, lately, and it might not show on this chart, I mean, he might have used the percent of stocks above their 200-day moving average. This is the percent of stocks in the S&P 500 above their 50-day, how they've been moving up recently. Well, of course they've been moving up when the market rallies in the last week or so. Now, I'm looking at the bigger picture here. This is a chart I've shared with you guys on the site, some of the members, I believe. This chart spans going all the way back to 2004, so this is over 13 years. And without fail, I've highlighted these periods of divergence, and we've had corrections. Some of these you can draw smaller divergences within there. You could show one divergent high right there. Coming onto this peak where there was a drop off, and there was a correction, and I'm sure if you measured that out, that's probably a 5-10% or more drop in the S&P 500. This is a big range here, and going from 700 all the way up to almost 2400 on this chart. But again, you have, the longer these divergences build, the damage is done. That shows deterioration in the market internals. Fewer and fewer stocks trading above their 50-day moving average, and without fail, again, going back 13 years, you can go back 20, 30 years if you want. If you can find a chart and mark it up that long, you're going to see the same thing. Without fail, these are the biggest corrections and or bear markets that we've had, have followed all of these divergent highs. Never have I seen one where the divergences were burned through. So again, I'm of the mindset that the damage is already done. The music has been played, and now it's time to pay the piper. Does the piper get paid right away, or is the piper going to have to wait a couple weeks, maybe a marginal new high? I don't think we'll see new highs in all the other major indices, but if we do, as long as the technicals, are still supporting the bearish case, this is what I'm waiting for. What I'm trying to say is I'm not going to flip from bearish to bullish if the S&P 500 or the Russell 2000 goes on and ekes out a 0.5% or 1% move over the previous reaction highs. This hasn't played out, and what it has played out for is a little blip so far. If we zoom in here, let me try to grab a smaller arrow. We zoom in here. Let me just modify this arrow tool real quick. Here we go. You see the recent blip we had, and it hardly shows on this chart. That's normal to see after the top is in. Each of these blue dotted lines mark the top. You almost always get a counter trend rally. I'm pointing to them here. Some are bigger than others, and sometimes you don't get one, but usually there was a little counter trend bounce there. Then the correction set in. So this little blip that we've had so far, and keep in mind we have not made new highs in any of the broadly diversified indexes. That's perfectly normal, but yet it seems that bullishness is just ramped up, and at least from people I talk to and what I'm seeing in the trading room, there's a lot of dejection from the bears. Those are their short the broad markets. But I wanted to point out that I don't see anything in this chart that says the bearish case is over. Or in fact, I see a lot of evidence, as I've already went over this chart. That red was the sell trigger line. We've never crossed below that line, that red line. the SPX A50R, which is a percent of stocks trading above their 50-day moving average. We've never crossed below it and not had a significant correction. So, take it for what it's worth. Let's just go through a few more. Here's the SPX A200R. So this is the percent of stocks above their 200-day average. This is a weekly chart, as you can see. And same story, without fail. I've marked all of the divergent highs. The red arrows show all the corrections. This actually, the question marks, I should have removed that. I had that pointed out at the time we made the divergent high. That was back in 2015, and the correction didn't end until here. And that was the biggest correction, either the biggest or the second biggest throughout this entire bull market. And it's not coincidence, mind you, as I point out, that we also had the largest divergence. I always say that typically, not always, but typically very much, you'll see that the larger the divergences are or the more steep they are. That's the other thing. You can have long-standing divergences that are building for many months, or you can have very steep, powerful divergences such as we have here. The bigger the fall is usually afterwards. So again, we've already topped, so I put the white line there. If I have to move the lines, I will. That's if we go on new highs, make another divergent high, it's just going to set up for a bigger drop when we get there. So you guys make the decision whether we're going to new highs and you want to try to eke out another 5, 10, 15, 20%. I don't know what you're looking for in the market. I'd rather be positioned early and catch a bulk of a move coming down here. And if I'm wrong, again, I'll take some losses. I'm profitable on just about all my shorts right now for the first time in a while. At least the last few weeks have been. We'll see. So let's just see what happens from there. But there's another chart. Again, the S&P percent of stocks above their 200-day moving average, clearly diverging. You can see the divergence down here with the. And this is one similar in the that I saw in stock charts. This is what the case they were trying to make is that you can see the percent of stocks above their 200-day moving average rallying up along with the market. What I see, again, it's your glass half empty, glass half full, how you look at it. I see a divergent high. You can see prices. This has not made a new high. It's slightly lower, while prices have made a very steep, the index has made a much higher high. And that is negative divergence right there. So that's what I'm looking at. All right, next one up. Let's see. This is the NAA 50R, Nasdaq percent of stocks above their 50-day moving average. I posted this one on the front page, so I won't spend too much time on it. Again, the Nasdaq has not made a new high yet, so I have the dotted line here. If the dotted line needs to be moved a little, I will. But you can look at this and see all other divergences. This one's every bit as big as these previous divergences, maybe a hair smaller than this one. That one was followed by a 10% drop. This one, after the peak, the market fell 20%. Every one of these were a correction or a bear market. And so without fail, again, going back, whatever it was, 13 or more years, and you can probably go a lot farther than that, without fail, following these divergent highs, you had corrections ranging from 10 to 56%. All right, next one up. And this is the Nasdaq. We covered the S&P percent of stocks above their 200-day moving average. Now, this is interesting, folks. I know a lot of you probably either been lost right now thinking this video is redundant. Like I've said, this market will not die, cannot die until the generals are shot. They got to get to the leaders, the generals, the big four I just mentioned: Apple, Microsoft, Amazon, Facebook. I see the comments in the trading room. Just pure disbelief how these things keep going up. And they're going to go up till they stop going up. They're the only story in town right now, and everybody's piling into them. Your shorts are just capitulating, and everybody wants to own them, and that's a dangerous thing. They're going to collapse under their own weight. And when they do, and this, again, guys, this is what I wanted to point out, shows you, I showed in the S&P that we had what they call flatline divergent. The S&P had pretty much made an equal, maybe a slightly lower high, but you can see even steeper, clear divergence with the NAA 200R, the percent of stocks in their Nasdaq trading above their 200-day average, much lower than this previous peak. So very strong and clear negative divergence here, and I don't see any reason why, again, this arrow wasn't drawn out all the way, because I must have drawn that at the time we had put in that divergent high, and wasn't indicating the scope of the drop, just that we were going to drop, say, just as I'm doing here. That doesn't mean that's my price target. And so again, you can go back in time, and this is yet to not play out. And if these divergences somehow don't play out and the market rises another 10-15% or more, then I'll have to say this analysis was wrong. Maybe it goes on to build another divergent high and lead to a much bigger correction down the road. And if that's the case, I'm just going to have to decide where to cover my shorts and reposition back when the time is right. Okay, here's one that calls the big trends, the primary trends, the big corrections. This goes back over 20 years. This is about a 21-year chart. Same thing. This is not the same thing that we were just looking at. I'm sorry, my correction. This is the Nasdaq advanced declining issues on a weekly basis. So up above you have the Nasdaq advancing versus declining issues, and then down here you have the Nasdaq Composite. And again, over 20 years of history here, and you can see Nasdaq Composite. This is the dot-com bubble leading up to 2000, clear divergence leading into there, which was a precursor to the huge bear market that we experienced after then. And we had divergence multi-year. These divergences take a while to build, and there was a pretty steep drop-off there. That was at the market top in 2007. So there's that 50+% bear market we had back from October 2007 into March of 2009. Along the way, we had this correction here that was foreshadowed by the divergence there with the advanced decline line, diverging against price. And what do we see here? We've had two series. We had a smaller divergence. You can make out that blue line there down below, the first blue line. And we had that huge correction back in 2015. And that divergence has only persisted. That led to this even larger divergence here. So really from this point on to all the way up to here, we have this large negative divergence that's almost comparable to what we saw leading up to the 2007 market top. So that's why I'm on guard or open to just watch how the charts develop on the next correction. Whether I'm correct and it's coming now, any day or any week now, or coming 3-4 months down the road, 2 months down the road, I'm on the lookout for what may be more than just the next buy the dip, 5-10% pullback. And again, we'll only know as the charts develop going forward. But this kind of gives us a good indication to be on the lookout for something more than just a little mild pullback to some of the first support levels. And on that, what I mean by watching the charts as they develop, you'll know it when you see it. What will happen is, if we're looking at much more than a 5 or 10% pullback, from my experience, this is what you'll probably see, is very impulsive selling, and you'll see support levels that are pretty key supports sliced through as if they're not even there, like a hot knife through butter. Maybe a brief pause, a brief bounce. Then you'll also see rallies get sold into quicker, or much more fast, or in shorter in duration. Maybe you'll retrace 32% or not even 38%. You'll also see bullish chart patterns, bullish divergences either not play out at all or begin to play out and then immediately get sold into. Those are some of the things that I look for during a correction to tell me, hey, this thing might have some legs. This might be the early stages of a deeper correction, or the opposite. We start seeing those divergences play out. We certainly saw this 60-minute divergence play out, but we haven't really, this may just be the first counter trend blip in a bigger correction, so it's too early to say. So again, we can only take the technicals as they come. It's hard to forecast right now what the next correction or pullback will look like, but we can certainly assess it when it comes. Last chart. Okay, this is the NAAD, another Nasdaq advanced declining issue daily chart here. So this one goes back 2001. And just another variation, you can see here the divergence, all the divergences drawn, followed by the corrections. Again, don't underestimate. If you can just try to get a visual or replicate this chart on your own, you can see these were very sizable corrections. And again, without fail, these divergent highs, we're seeing the NAAD cumulative down here, the Nasdaq Composite up here, without fail, these divergences have always played out for meaningful corrections and or bear markets, and I just absolutely can't see any reason why this one's not going to play out for it and play out for it sooner than later. I'm going to wrap this up. I know this video has gone long. If you're still with me, I'll give you an interesting story or an analogy really for this market. Back in 1957, there was a herpetologist, a famed herpetologist. His name was Carl Schmitt, and somebody had brought him in a snake. It was just a juvenile snake. It was about 30 inches, called a boom sling. Now, boom slings are very venomous, but he didn't. He was a little careless with it. He didn't identify it as a boom sling right away, dismissed it as that, and in handling the snake, it bit him. Well, what was interesting about this is he documented his death. 24 hours after that bite, he was dead. And this is what I want to impress. I think the damage is done. I think the handler has been bit, and the thing about a boom sling, it has a very extremely toxic venom. However, it's very slow acting. It's not a very aggressive snake, but those people that get bit usually die, not only because the venom is so toxic, but because the symptoms are delayed. And I'm just going to real quickly run through his story. So he was bit handling the snake, and bit him in the thumb. A little bite. He tried to suck out the blood. Didn't think too much of it. And then, but what he did as a scientist, he started documenting. He pulled out his journal and started documenting how he was feeling after the bite. So 4:30 to 5:30 p.m., strong nausea, but without vomiting. And then he wrote that he jumped on a train to go home. No big deal. 5:30 to 6:30 p.m., strong chills, shaking, followed by a fever of 101.7, bleeding. He was bleeding in the mouth. Started around 5:30, mostly from the gums. 8:30, he ate a couple pieces of toast. At 9 o'clock, he said he went to sleep, slept like a baby up to about 12:20 a.m. Got up, peed a little blood, drank some water, and then he had violent nausea and vomiting. He threw up the toast, and then he slept. He fell asleep, and he slept like a baby real good until 6:30 a.m. So now what I'm getting at, this sort of reminds me, that story of where we are right now in the market. If I zoom back to this 60-minute chart, this is what I think is going on. Okay, this was that first move down off the highs on March 1st. As I pointed out a minute ago on those charts, during almost any correction after top, you have snapback rallies. And last week seemed to be, from all accounts that I could hear, people calling for that the correction was over, that we're heading to new highs, and that seems to be, how Carl Schmitt had felt during this point. Thought he was getting better. So let me continue the story. We're almost done. He didn't live much longer. So he woke up, continued on with his morning as usual. He ate a big breakfast, coffee, cereal, poached eggs, applesauce, the whole 9 yards. His temp was down to 98.2. I think that's where we are right here. And then he wrote in his journal, September 26, 6:30 a.m. Temperature 98.2, ate cereal, poached eggs on toast, and applesauce and coffee for breakfast. No urine with an ounce or so for blood about every 3 hours. Mouth and nose continuing to bleed, not excessively, end quotes. Excessively was his last word that he entered in that diary. After lunch, about 1:30 p.m., he vomited, called his wife, and by the time the paramedics got there, he was unresponsive, covered in sweat, unable to talk, and he died shortly after that. So just who knows? Maybe not. But that's my analogy. So don't be fooled by counter trend rallies. Look at the bigger picture. And again, going back to all those multi-month divergences that I pointed out with deteriorating market internals, and I pointed out recently how the just a handful of stocks have lifted this market on the rally. That's my current take on the market. If the technicals change, if I start to see broad participation on the rally, you know, then I'll try to change my tune as quick as possible. It'll almost entail taking losses on my existing short positions. And that's that. But as you guys know, I trade a long short portfolio at almost any point in time, especially now. The primary trend is still up. I'm seeing sectors, you know, opportunities all over the place. Commodities, solar stocks as of recently. There's just always somewhere to trade stocks long and short. And until we have a primary trend, or at least an intermediate trend that's confirmed to be bearish, I'll continue to trade a long short portfolio, and also make sure I don't go too aggressively short. But if we see these recent lows taken out, like I said, that especially if there's not any divergences in place or anything that gives me pause, that will likely be you know, the next big sell signal. And my guess is if we start to get there soon, start to move down, then before we even get there, that'll be like a black hole, a vacuum. It'll just suck prices down there, and we'll probably smash right through there. So I don't even expect much of a reaction. Okay, let me wrap it up here. This video has been long enough. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.